All right, well, welcome everybody. We are super excited because we have a triple N investment opportunity for all of our accredited investors tonight. And it is so close to home. It's in South Lake, Texas. And we have with our multifamily, the cash flow isn't necessarily a consistent thing happening right now, but with this investment, it surely is. So we're super excited about bringing a new opportunity to our investors with some monthly cash flow. And it's also a no debt asset. So I'm Andrea Swick, and then we have Rachel Grine and Julie Roy that are the team leaders on this asset.
Yes. So this is some legal disclaimers here that we are obligated to provide you. I'm going to let you guys you can pause the replay at this point if you're watching it back and read through it. I'm just going to quickly go over some of the highlights. Essentially that everything in this document is not intended to be or should be construed as legal advice. We encourage all of our investors to do their own financial due diligence, whether that means talking with a financial advisor or consulting your CPA before making any decisions that could impact your finances or taxes. So this is also not the official offering. You will find that in our portal, which will be linked at the end of this presentation, or if you're watching the replay, it'll be linked down in the description, that it will contain the official offering. This is for informational purposes only. Okay, this is Andre and I, and we are, of course, the co-founders of Good Investing. If you're watching this, you probably know us. And we have a really successful track record so far in commercial real estate. Currently, our real estate portfolio totals over 105 million in assets under management across a multiple asset classes. And we are very excited to be adding triple net to our belt with this investment. And we have been featured in many publications over the past year, which we're really excited about, and let you guys read about that there.
Hey, sorry, I had to
talk about yourself.
Yeah, I'm sorry, I was just unmuting. So I'm Julie Roy, and I'm partnering with both Andrea and Rachel on this amazing opportunity here tonight. Myself and my husband, Dr. Bo Roy, work together in Roy Holdings, LLC. We own quite a portfolio. It's diverse as well. We do have a large triple net portfolio or component. We have a multifamily component, and then we have some storage and industrial. So a few different asset classes for us as well. We were entrepreneurs in the childcare space for about 22 years. Prior to that, I worked in childcare while I was attending university and college. My husband is a child psychologist, so lots and lots of child stuff in our background. We have 4 children as well. In terms of the triple net portfolio, we own an array of asset classes as well within triple net. We have 3 Starbucks currently. We have some O'Reilly's. We have a couple AutoZones. We have Taco Bells. We have Family Dollars. We have Kinder Cares, which are other learning institutions, early learning institutions. We have a TLE similar to the offering that we have tonight. We own that one in Florida, just outside of Tampa. And then we have this TLE here in Texas. We own in various states: Nebraska, Oklahoma, Texas, Florida, Minneapolis, Kansas, Missouri, Tennessee, and I believe we may be adding one more state to that very soon. We have about 2,700 doors and about 300 million under management in the multifamily space. We live 100% passively off of our triple net cash flow. My husband retired out about 10 years ago from his practice due to the schools that we owned and platforming them and the sale of our real estate into 1031s to purchase triple nets to continue to have some really great cash flow. And then we just use the multifamily to eradicate the tax. But we are absolute lovers of triple net. So that's really a little bit about us. Andrea?
Hitting that unmute. Okay, so yes, so the TLE is a triple net lease. For those of you who aren't familiar, it is where the tenant basically pays all of the expenses. So there isn't like in multifamily, which we have, you know, a big portfolio of, we always have a month-to-month differences on occupancy and economical vacancy and you know, if all bills are paid and all of that. So there's a lot of variables, but with triple net lease, there really isn't variables. So we love this asset because it is one tenant with a long-term lease, and then they pay property taxes, insurance, and maintenance on the property.
So sorry, I had to come off mute as well. So yes, some investment highlights. Like Julie and Andrea said, this is an early education business. It's called the Learning Experience, and they have been in business since 1980. That is over 43 years, and they have since opened over 450 locations nationwide. And they are corporately owned, and we have signed a 20-year long-term lease with them. The rent is actually guaranteed to $1 million, which is fantastic for risk mitigation. And they just recently took possession of the building. This is a brand new build. We're going to have some photos and some aerial footage of it later on in the presentation. And 126 children pre-enrolled, which Julie, I think you said that just went up, right? It's a little bit more now.
A little bit more, just under 130 now. So yeah,
that's awesome. And we do expect to open with a full wait list, which is not surprising given the local market and the local market's demographics. No debt. We're purchasing this all cash, which really limits the volatility right now in the debt space. Immediate cash flow within 30 days of closing. And this will be a trophy location for the Learning Experience. And then if you are not familiar with Southlake, Texas, it is a very affluent area. The median household income is $283,000 as of 2023, and that's within a 5-mile radius of the center.
awesome.
So a little bit more about Southlake. Over the next 10 years, future job growth is predicted to be 44%, much higher than the US average. Super highly rated schools. And it's also considered one of the safest places to live in the country.
Awesome.
Julie, you want to talk about the tenants?
Sure. Okay, I'm unmuted. Great. Yes, I'd love to talk a little bit about TLE. So like I said, we own a TLE in Lutz, Florida, which is right outside of Tampa. They have been phenomenal tenants. A couple things. Ours is a little bit different in that it's a franchisee that owns the one in Florida. He owns 6 of them. So we had to vet the franchisee in a different way than we would vet corporate. What we're really excited about on this one, though, is that it's a corporate tenant. And so the actual corporate office will be running, maintaining, and basically presenting this location to the public as a trophy location. So they will be honestly doing a lot of training in this location for franchisees. So a lot of hands-on operation here from the corporate structure, which we love. They started in 1980 with a single location in Boca Raton. It was a mom and pop family, very similar to how we started our locations, which we really enjoy the mission, vision, value that they have and the learning style for the kiddos. They quickly expanded. We didn't quite get to 450 locations like they did, but they've had some real great success in the market. The company is one of the nation's fastest growing early childhood and childcare franchises. They have a huge proven track record. They're really, really supportive in terms of their franchisee model. And then obviously their corporate model will be sort of those trophy locations. They're planning on bringing in 6 trophy locations into Texas. They're really expanding in the Texas market, have a really, really strong background, obviously in childcare and in providing services for early learning. There's more than 95% of their preschool graduates read before kindergarten. They have a really great academic program as well as a whole child program. So we just really, really enjoy what they're doing in terms of the space and what they're able to offer families in the area. I'll talk a little bit about returns. So this is a triple net investment, like Andrea said. It is a 506c, so it is for accredited investors only. There is a $120,000 minimum investment. The monthly cash flow per $120,000 is listed beneath here. We do start cash flow basically day one. So we only buy properties that have cash flow. With this investment, in years 1 through 5, we'll be making yearly payments of approximately $6,800. Monthly, that accounts to be about $571 a month. We can never say guaranteed. There are really two risks in the triple net space. One is Mother Nature, so we can't control, obviously, floods, things like that, even though the tenant has to pay for all repairs, getting the building exactly back to order and all of those pieces. Cash flow may be stinted during that time. If that were to happen, we have business interruption insurance, but we all know it takes a bit for insurance to come back in. So that would be one issue if we had to, in terms of mitigation of risk. The second one being that the triple net closes entirely across all of the states. Then if they closed across all the states, they wouldn't be responsible to pay the rent to us. But if they closed only our location, we do have $1 million guarantee, of which we could remarket the property or do whatever we wanted with it. And because we're buying without any debt, that gives us a lot of options and a lot of freedom in terms of when or if we ever wanted to sell the property, we have full control. So those are some highlights. The percentage return per year in the first 5 years will be about 5.71% cash on cash. You'll see that there's a total of about just over $34,000 in the first 5 years. In the next 6 to 10 years, so what we also want to talk about is these rent bumps. So rent bumps are already mitigated and in the lease. And so on years 6, 11, 16, you'll have a rent bump of 10%. So that is a 30% increase from year 1 through year 20 if we held the entire term. In years 6 to 10, you'll be making approximately another $37,000 or $628 monthly. It bumps up a little bit because of that 10% increase. So, and then years 11 through 15, you're bumping up to just under 7% with a $691 monthly payment approximately, or $8,000 a year in cash flow, which amounts to about $113,000 total from years 1 through 15. And then you can see in 16 through 20, we're bumped up a little bit more, another 10% increase to $760 approximately, or 7.6%. Again, we cannot say it's guaranteed because those two risks that we mentioned earlier, but what we can say is that it's consistent monthly cash flow. And so total returns, $159,000 if we kept the entire time. And this is just cash returns. Remember, the $125,000 of equity that you currently have in the building is backed by real estate, backed by the entity, and that is not included in your return here. So this is basically just your cash returns. You want me to continue?
Yeah, can you talk, because I think you just mentioned kind of how that figure was only factoring in cash flow. So let's talk a little bit about the appreciation of the real estate.
Sure. So there's a few scenarios here in terms of appreciation, cash flow, and returns and sale. So for example, if we sold at the same cap rate we bought it for, and you would have that 10% rent bump in the NOI, and that's what the appreciation would automatically be, plus any appreciation that there would be in the market in terms of the actual building and property. But that is if we sold at the exact same cap rate. If we sold at a cap rate that was even 0.5% or 1% less, there could be instrumental returns because we sell based on that NOI or that net operating income. So if we sell based on a net operating income that is even just a 10% more than we bought it for, you're already looking at returns of that level. And so if you add on, another 5 years or a second rent bump, you're adding a 20% NOI plus whatever appreciation you have in the market. And so you can be anywhere from 1.5, honestly, upwards of quite a bit more. When we sold our childcare centers, we were upwards of 6 times. Again, none of those are promised because it really depends when in the market you sell, what cap rate you're going to be able to sell for, and then what your NOI currently is at the time. So there is some variability in terms of exact exit strategies or plans, but obviously we would never sell for what we bought for because we want to make sure that the appreciation that we are able to afford all of you is definitely a nice, healthy appreciation to share. And also we would probably not sell before any rent bumps because you definitely want to have that increased NOI to increase the sale price. So hopefully that that helps.
Julie, can you quickly talk about some of maybe the more granular finances? We can just briefly mention these points.
Sure. So I have a whole business plan as well that Andrea can share. I think they have it as well. But basically that the LP-GP split is really advantageous. Most GP and LP splits are upwards of 80-20 or 70-30. We are really, really wanting the LPs to make as much cash flow as possible. So we're doing a 90-10 split, which is pretty much unheard of in this arena and in this space. And so we felt like that is definitely a pro for going with us in any of our deals or any of our offerings. We feel like that we want to have the best return, you know, for the LP. The net operating income is $415,000 starting in year one. There's also a full lease and ramp up, because obviously we have those ramp ups in 6, you know, the years, those 3 ramp bumps. So that would increase, but on year one, the net operating income is 415. A couple things I want to talk about here, just because it's not on the slides and it might be something that you would like to know. One of the things is that obviously the LP-GP split would be 90% of that net operating income would go to the LPs. What we've done though, mostly when we buy childcare centers, they have a ramp up period. So rent ramps up with enrollment. And so we were like, nope, we don't want that. We don't want to take that option. So the developer is actually paying us all the rent ramp up abatements up front at closing. So we'll have cash at closing for any of the rent abatements that were promised to the tenant. So that is covered. So we don't have any differences in rent at all starting year one. So we get the full rent year one. The other thing we did is we created a ROFR, or a first right of refusal, to add an extra layer of protection in case by any chance there is this loophole in the lease saying, you know, well, we have a corporate guarantee, but if at some point we want to go move it to a franchisee fee or a franchisee after we've, you know, moved through this guarantee, that they could do that. And I said, no, I'm not comfortable with that. We want to make sure that we have a say on who the franchisee will be, or if we could take it ourselves, that would be an option as well. So we have that extra layer of ROFR in there that's already added in. So there is a few layers of mitigation here that are above and beyond what would normally, like, no one even puts that language in these leases. And so they were surprised we asked for it, but they did agree. And I feel like it's something that we should share to let you know that we are super committed about having that extra layer of mitigation for you in protection. Closing expenses are about 2.4% on average. And so those those are raised and are already in the pro forma. So that doesn't come off of what you make at all. The total price we're raising for is 6.54. We are not taking any debt, so we're raising the entire portion. The GPs will have money in as well. The disposition fee, there's no acquisition fee and there's no asset management fee, because again, we wanted to keep as much cash flow going to y'all as possible. We are taking a 2% disposition fee at sale of property after we've given you what we have promised you. That's just, we feel really great about being transparent with that and communicating with you and providing value to you before we take any of that fee. But again, it's a 20-year lease, triple net. I think those are the main parts of the deal.
Thank you, Julie.
Yeah.
Andrea, do you want to talk a little bit about the building photos, and then we'll go into the local demographics, which you can speak on as well.
Yeah, so this is basically the asset. This is actual photos of the new construction. What you don't see here really is that there still is a little bit of construction that they're doing, but for the most part, it's pretty much built, and they have, they're really, really close to opening and ready to go. And here's pictures of the playground. And then we do have an aerial video footage that we attached in our email. So if you haven't had a chance to see that, we will show it to you. But it is just in a prime location with a lot of, you know, buildings, restaurants, all the things close by. So the location is definitely fantastic.
Yeah, just one thing I want to mention, if we can go back, Andrea, are the vehicles per day. So we don't buy anything that's less than 40,000 vehicles per day, you know, that would cross our location. This is upwards of 53,000. So you can see it's at, you know, access to a major intersection, easy in and out, great remarketability, and on a really main thoroughfare. I'll talk just quickly a little bit about the video so you can kind of see the placement of TLE here. Brand new. They just put a retaining wall in as well. It's a beautiful property. I think someone is from Frisco, so may know a little bit about the South Lake property as well. Someone on the call, I mean. So if you have anything to say as well about the location, feel free. But basically, this is a really great location for remarketability. I wanted you to kind of have an idea about the amount of land or the amount of land that is not available around it. So there's not a lot of area left to build on, which is really great for us in terms of remarketability. There's a lot of office spaces here. There's a lot of office park. And then less than a mile away, we have some really big names like Sprouts, which is like a Whole Foods. There's a Chipotle, there's a Starbucks. And so all of those folks, if you know anything about triple net, those types of triple net do a lot of demographic studies. So it's really great to know that we're in the area where all of these folks are appreciating job growth. There's a population growth. There's a great median income, and there's affordability in terms of the tuition rates. This is actually the highest tuition rates are currently in Dallas-Fort Worth. South Lake has the highest tuition rates. And so there's a real strong case for what the rent is and what the population growth is and the need for childcare in the area. And so in a second here, it's a little bit, it's going to give you a little aerial view of the cross section, and you can kind of just get an idea about the amount of traffic that comes through. And this was just on like an early afternoon, not at a rush hour time or anything like that, just an off time. So speeding up now. So there you go. So you can just, what I really want you to see is this part here. So, you know, 8 lanes of traffic, huge intersection, really big retail space, bunch of triple N's all around it. Just, yeah, we just love the real estate. We love the deal, but we love the location. And so just something we wanted to give you a little Apple view of here. Yeah. So.
All right, everyone. Go ahead, Andrea.
I was gonna just open it up to some Q&A. If you are wanting to reserve your spot, please scan this barcode and you can do your soft commit. And but we do want to open it up for some Q&A if you have any questions for those that are live.
I have a quick question. I know that we are filling quickly. Julie, do you have an updated figure for us on, as of right now, what is it? It's Monday, May 22nd. How many shares we have left?
Yeah, so we started off with 54.5. We had 12 go the first day of opening. We've had since about another 10. So I would say we're probably over about a third full currently, and we haven't yet uploaded SEC docs, just a real soft opening. We've had this Zoom and one other. So, you know, we're probably about a third right now subscribed.
Okay.
Yeah.
And I would recommend to anybody watching, if you know, this investment does interest you, go ahead and make a soft commitment just to hold your spot in the deal so that, you know, your shares aren't taken away before you're able to make a decision. Any other questions?
Question here. What is the so what is you said the NOI is $415,000 per year. What is the rent per month?
So $415,000 is the year one rent. So that would be the same rent from years 1 through 5. And then we'd have that rent bump in year 6. And so 415,000 of that, 90% goes to the LP portion, which I think ends up being like 336. Let me do quick math for you. Let's do 415 times 90%. So that's 373,500 for the LP NOI or rent for the year. So if you divide that by 12, the rent per month is 31,125. And another thing we'll talk about is the expenses. So people have asked, you know, are there any expenses that come off of this rent at all? So basically, no. The only thing that comes off of here would be we take an insurance policy out in addition. So we hold a $2 million liability insurance that comes out of our 10% of the GP side. So it doesn't touch the LP side whatsoever, but the insurance policy comes off of that, off the 10%. So for you, as well as all of the other LPs, we're talking about approximately $31,125 a month. So in that first 5-year term, if you can go back, Rachel, to the business plan, he can kind of see what the monthly is on that for years 1 through 5. So you'll have about a $571 distribution per month for the first 5 years.
Okay. So basically, you're assuming that your NOI is almost the same as your gross rent because there is because this is triple N and there's no expenses.
Yeah. So basically, our NOI is what we would consider our full gross rent. Yeah.
Okay. Okay.
Yeah.
And you said we are about like less than 130 enrollment, and I'm very familiar with the Salt Lake area. What is the capacity of this entire unit?
Yeah, so there's about 180 spaces and they expect to be full with a wait list on opening. So they've slowed down enrollment actually because we can't start 120 kids at one time. And if you're in childcare, you would know that would be a disaster for us. So we've slowed it down a little bit, but they're on a wait list. So they'll come in sections, but they expect to be fully waitlisted by opening. They were waiting, last week we were waiting for a CO. So we're probably going to get a CO anytime now and probably opening to the public June 1st is what they have slated. So ready and, you know, getting lots of calls, lots of enrollment inquiries. So doing really well and really fast with enrollment. It's been actually way faster than they had imagined. So yeah, they're pretty excited about the enrollment numbers.
And then who has developed and built this property? Is it yours or like somebody else and this was purchased?
Yeah, so we work with developers and they actually have developed the property. We have bought $65 million personally from a set of developers that we work with. And then we've done an extra 20 or so million in syndication. So when closing the 65 million independently, that's just my husband and I own just the 65 million alone. We've worked with some really great developers who now give us sort of first option at these properties. And so that's how we met this developer and have worked with him before. And like I said, we own that TLE in Florida as well.
Okay. Do you know what is the market cap rate for this type of business in the Salt Lake area?
Yeah, so we're buying it at a 6.5, and it ends up being amortized around a 6.28 to a 6.3 once we add all of the expenses for closing. So SEC, lawyers, accountants, we have to do a survey. We always do an extra phase 1. We do a bunch of stuff to just ensure that we're protected environmentally, that the survey has no easements or encumbrances. We ensure that everything is clear, obviously title, all of those things as well. So we take all of that into consideration, which pushes that amount to the 6.3 rather than, than the amount without all of the expenses. And so the cap rate goes down a little bit once we put those expenses in. So we're right about that 6.28 to 6.3.
Okay.
Mm-hmm.
And I guess hopefully my last question.
What
What is
so
yeah.
when you ask questions, people will have the same. So it's great if you ask them.
So for a kind of limited partners, what is the exit strategies? Like, I mean, what are the exit avenues?
So the strategy and avenues is that it's generally a longer term hold. What we see it as, so we do a lot of triple net. Obviously, we said for the cash flow portion. One, I'll give you sort of our reasoning and why we think it works for most LPs is that we have money in the bank. Obviously, that's not protected by any hard assets. That's just money, cash in the bank, so liquid. We love to have our cash backed by real estate. So equity in real estate for us, because the appreciation is definitely better long-term and it creates legacy wealth for our family. We like to have a cash flow monthly because that's what we live off. We live off all of the triple and cash flow, which makes it a really nice, positive opportunity for us to continue to build cash flow monthly while we are appreciating the asset of the real estate through the NOI, through the rent bumps, through those types of things. So it's not really a quick hold. These are definitely more long-term holds. Our strategy would be either, like I said, after a rent bump to look at the market where the cap rates are for sale and look at what the NOI is. Obviously, I don't think we would have any reason to sell before a rent bump unless there was a really significant cap rate change, which could happen election time. I mean, those things do happen. And the cap rate right now hasn't moved a huge bunch yet. So we'll see kind of how that is reflected in the market. But normally you would have a cap rate change along with an NOI rent bump to create the most positive environment for selling a triple net. But we would only do what makes sense for the investor and the LP. If you can continue to get cash flow, creating equity on your asset that, on your money that's backed by an asset, we would just continue to bring in that cash flow for you. If we thought that there would be a huge advantageous, time where we could get an increase in NOI with a rent bump, as well as a market shift in the cap rates, and we can bring in $1 million and share it all with you, then we absolutely would take that to our GPs and say, hey, like this might be a good time to try to put it on the market and get a huge return for our investors and do it again in another new property. And so that's sort of what our ideal would be.
And I'll just add, I am diversified across a lot of different assets, including Airbnbs and single family rentals and a lot of multifamily. And what I love about this deal, and I wish I could sell my Airbnbs and just get into this, kind of triple N space more, because it is a consistent cash flow and it very much is like a set it and forget it type of asset, and there isn't those ups and downs like there would be even in Airbnbs, and mine do pretty well too. So, and you're not only getting that cash flow, but you're also getting that appreciation, which you did say during the presentation, Julie, but I think you have invested in triple N before and it's gone up exponentially. Like I think you said 18 months and it went to 6x.
Yeah, so
in appreciation. So
the property we have in Frisco, it's also a childcare center, and we have 3 kinder cares: Frisco, we have McKinney, and we have Maple Grove in Minneapolis. And McKinney and Frisco, specifically in Texas, have gone up over $1 million in an 18-month period in value. So I think that if you get the right location, the key here is, getting the right location, ensuring that the rent is fruitful and profitable for all the LPs, and that you have enough rent to create an offering, which this is a really amazing rent NOI. And just, the stability. And when you say set and forget, we truly do nothing. And every month our, bank account fills up with all this triple net money as if we're working, but we're not. So it's nice to have a set and forget passive income. And we base our lifestyle, like I said, on that passive income. And so it's very consistent for us. Again, it's not guaranteed, but it is very consistent. We haven't had since we've purchased triple net, we have not had any instance of someone not paying the rent or stopping rent or, a triple net provider leaving the site or anything like that. I think when you're dealing with a magnitude of a corporate level tenant, it does assure some type of risk mitigation as well. Triple A and triple B tenants are really great folks to have. They really just send checks. I mean, we don't hear much from them unless in the beginning they're giving us a rent, like I said, abatement, or there's a roof warranty that that we're switching over to us or something like that. But I mean, there really isn't the nuances that we deal with when we GP for multifamily and other types of asset classes. And so people really like this for consistent cash flow because the other ones do have some volatility in the market. There is a little bit of up and down with different asset classes, and this one stays fairly stabilized. So it's a nice additional asset class if you're looking to create cash flow.
Another two more points that I'll make is typically you wouldn't see triple N as an investment opportunity as a passive investor. You would see something like this in a REIT, which means that you would not get the tax advantages. But in this particular instance, you would be a co-owner in this asset for this one asset, and the tax depreciation is carried on to you as well.
I don't think we've mentioned that figure.
So we're doing a cost segregation. Normally it's 25 to 30%. I'm going to talk a little bit about that as well in comparison to multifamily. So initially we did the multifamily for two reasons: the tax, obviously the tax depreciation through the cost seg, and the ability to eradicate the passive income through that. This year, however, for most people investing in multifamily, it's something to kind of understand. When you have more debt from the bank, you have higher levels of depreciation. And that's going to be the same for multifamily. So even though currently, we're being offered 80% by the government for bonus depreciation, it will be 80% of something closer to 30 to 40% depreciation this year due to the interest rates and the level of loans being given. So the banks are being very strict on loans. So there's not a lot of loan amount being given. It's more how much you're raising. And so when you raise more money, the loan amount is less. When the loan amount is less, it directly affects the depreciation. So before, there was a huge disparity in what the triple net depreciation was versus the multifamily. This year, I think we're going to be more on par just due to the nature of what's happening in the banking system with the rates and the way that the loans are being sort of given out for these multifamily locations. So I would say you're probably going to be around 25 to 30%, but we will have a quote done and then we'll have final numbers about a month after. So you'll know exactly from a tax perspective where you'll be. It looks like we usually can eradicate the first 2 full years of profit or return of capital. And then after that, there will probably be, there would be some type of income. But if you have other multifamily deals, that income can go to any one of your passive income. So you can spread it around or do, whatever is best for you from an income tax perspective. You could also claim real estate professional status to help with that if that's something that is available to you. I also wanted to talk about one other thing. You mentioned what did you just say, Andrea, about the
about typically there? Yeah, go ahead.
Yeah. So what I wanted to mention about opportunity as well was most folks aren't able to do triple net opportunities because of the massive amount of capital needed to get these deals done. So when we do deals on our own, we have to come in with like 30 to 50% minimum. And that was in a good interest rate. And now when we do them on our own, we have to come up with 100%. So if we were going to buy, for example, this TLE, we'd have to come up with $6.4 or $6.6 million out of our pocket at once. So most folks don't have the ability to buy these triple nets out of pocket cash. There is some availability to do 1031s with no debt, which is an option for some folks. But if you wanted to just buy triple net for the cash flow portion, we just felt so many people asked us, hey, Julie, how come you want to offer these things to folks? And I said, because so many people keep asking us to partner or JV with us on triple net deals. But when you JV, you can't have someone bringing in 4 million and someone bringing in, 20,000 or 120,000. So we said we could make them equal shares. So it's like a partnership, even though it's a syndication, they're getting 90% of the cash flow. They get all of the benefits without putting up a ton of capital. And I think that's what's really helpful and fruitful for the LP, because they would otherwise, most folks could otherwise not do deals at, $2, $3, $4, $5 million at a time. this also helps mitigate that, because you can be in deals for 120 or 240,000, a couple shares, whatever you want, versus having $1, $2, or $3 million in a deal and all of your eggs in one basket. So it's a bit of risk mitigation, as well as there's some component of preservation of capital to do more deals and be spread across more opportunities to create cash flow. And so that's basically what we've done for ourselves. And we just wanted to offer it to others because it's worked really, really well for us.
All right. Any other
question.
questions? Yeah, go ahead.
I think I missed that in the part of the webinar. How much are the LPs putting into the deal, and how much is a GP? Because there's no debt structure, so the structure is only LP and GP putting the money in the deal, right?
Yep. So 90% will be LPs, 10% will be GPs on the split.
Okay.
And nobody can put more than, no one can own more than 20% in a triple net syndication deal. So the most I think we've ever had is 18% that one person has come in with, but most folks usually come in with 1 or 2 shares. Generally, that's pretty much I would say the general consensus, and what we've seen has been 120 to 240,000 based on whatever cash flow they were hoping to get in terms of the return. So we have had people do more than that. Like I said, I haven't had any do more than 18%, and that's not typical. That's if you have a lot of capital and just really want cash flow. But we suggest that you do more deals, less money, more deals, and just mitigate across deals rather than putting, that type of money in one deal. There's something that you're really loving about, obviously, the deal.
Mm-hmm.
Yeah. So no bank debt at all.
And then you're talking about 1090 out of 6.5 million, right?
So it'd be 6.54, but you're not, remember what you're doing for the triple net is you're getting 90% of the NOI or the gross rent. So we're talking that 300 and I think 373.5 was it? You would split that 90, that's the 90% in terms of so say you have the NOI, it's 415, 10% of that goes to the GP, the other 337.5 is shared in the LP side. And then the shares under that would be anybody under this NOI, any LP would get their portion of return on that share. So for example, if you did 120, you would get a $571 a month monthly payment. Or monthly distribution. I shouldn't say payment, but it feels like that. Does that help?
Yeah, so basically it looks like there are about 49 LPs, right? Shares.
Well, it depends on how many shares each of the GPs take. So some of our GPs take more than 1 share, right? So if all of the GPs wanted, I mean, they could take as many shares, anybody could take as many shares as they want. So even an LP could technically take 4 shares, 8 shares, whatever, but each share is 120,000. And then each share from that NOI, the 415, the 337.5 is shared on the LP side.
I think I understand what he's asking. I think he's asking out of the entire raise.
Right.
I think he's asking if the LPs are taking up 90% of that raise and the GPs are taking up 10% of that raise. That's not necessarily the case, is it?
No, that's just the split on the NOI. So like the GPs could have more than that, the LPs could have more than that. But whatever the raise is, you're allowed to basically buy as much as you like, but no one can own more than, let's call it 18% of the deal individually or via an LLC with one person or one group.
Okay, so basically my understanding was the 6.54, that was the total raise, and 90% of that is being raised by the LP, which is not the case. That's not the case.
It could be the case.
It could be the case, but
we don't have the final numbers yet. But we, sometimes we have 40% through GPs that want to be in the deal with heavier amounts of money, right? Like we had a GP last time that wanted to be in for $1 million, right? So it was still less than, I think 1.2 was the 20%. So there's an 18%, person, but the NOI, no matter what, it doesn't matter who is coming in terms of the sale price and the raise, it wouldn't matter. It's how much of the split they would get. So they're getting 90% of whatever comes in, of the 373.5. That would be the LP side no matter what. That's 90% of the NOI, not 90% of the sale price. So
Okay, yeah.
373.5 is totally for the LPs. GPs will never cross over and take any of that.
Okay. May I know how many shares of LPV you have right now total?
Oh, I'd have to check cash flow portal today, but I think we're about 18 or so.
18 taken, or is it 18 total?
18 taken. Oh, total. Again, it will be as
It
many as,
depends. Yeah.
yeah, because we're always dealing with the NOI, not sale price, where in multifamily, you're more looking at sale price and then the value add portion for the payment, where we're dealing with like, here's the NOI, 90% of that NOI is going to be allocated to the LP. So that 373.5, so 373,500 will never, you will never take any of that to the GP side. That is the LP side. So if someone comes in with 7 shares, that's 7 less openings, right? So like, it's hard for me to tell you how many LPs there'll be, because what if someone says, okay, I want 1 million. So then, okay, well, how much is left in shares on that side, right? So it's a little bit tricky to give you a number because it depends on how many folks buy more than 1 share. Like, for example, let me just, I'll create an example. I just did a Starbucks, okay, with some LPs. So we had 21 shares available total, right? So we, GPs took 3 shares. So there was, let's call it 17 shares, 16,
18. Yeah,
right?
18.
Whatever's left, those shares we thought, okay, is available to 18 people, but we inevitably only had 12 people because one person bought 500,000, which was 4 shares, right? So it really depends on how much they're buying to note how many shares are available.
Yeah, but I mean, to begin with, you knew that there are 21 shares available total, right?
Yep.
So
this
that's my
is-
question. I mean, right now, what's the total share available to like begin with?
So 54.5 was the total shares available at the beginning.
Okay, 54.5. Okay.
Yeah. And that's for everyone, GP or LP.
Yeah.
Total. Okay, perfect.
Yeah.
We got
Yeah. That was my question. Yeah.
Sorry.
So there's a bit of confusion on my side here. If the GP is going to get only 10%, what if the GP puts more money? Will the distribution be more to the total of the LPs, even if the total of the GPs, they put 50% of the deal?
So the GPs are always, okay, so the share is a share, no matter what.
Yep.
$120,000 gives you the $571 a month. It doesn't matter who you are, which side you're on, you're making the same amount off of the NOI per share. So if I put $120,000 in, I'm making $571 a month. Because I would be in as an LP. So the GP, if I come in and want to buy a share, my share goes on the LP side. Does that help?
Yeah, now understand. Okay, I see it now.
So the GP is just for basically the what we call the managing partners of the deal. They will just get 10% of the NOI. When they want to come in for an investment purpose, they would come in on the LP side, just like you all. So there's 54.5 shares available. If I want to buy 2, Rachel wants to buy 4, Andrea wants to buy 3, Ramon wants to buy 6, Mike wants to buy 2. It doesn't matter. We are still getting the exact same split that you see in terms of the monthly payment on your investment. But we get the deal in general. The NOI is split 10% general partners, 90% LPs.
And that 10% to the GP is for sweat equity based on our contribution to the property.
Yeah,
Yeah.
not an LP component.
Yeah. Yeah.
Yeah.
It's not investment, just sweat equity. Okay.
Yes.
Okay.
So if you're an investment, it's the same as you. We're in the same exact position, getting the exact same return. If we go to the LP.
Okay, and then the exit, the sales, is it 90-10 also? Or
Yep.
is it,
So the exit for sale will be sale price minus 2% disposition fee. Any of the upside split 90-10. on top.
Awesome.
Your,
Okay.
obviously your original return of capital. Now, people have said, well, what about if I need to exit, or there's an emergency, or, you know, I need to get out? What do I do? So there's options for that. You would be able to, 1, sell to another LP, 2, sell to a GP, or 3, sell to someone in the market with approval from one GP. So there's options, but you can't sell prior to holding until the first rent bump. So you'd have to hold for 5 years.
Okay.
And then you could get out if you needed to, if there's an emergency, or you just, you know, I mean, we don't discourage getting out because you can't sell your share for appreciation. So you have to sell your share for the initial cost you bought it for. You can't get the appreciated share at the rent bump. So you would be getting, you know, the $120,000 back plus whatever you've made in cash flow, but you will not get the appreciation that the deal has, you know, now bumped up to
Okay.
leaving, right? So you don't get the benefit of that. Does that help?
Yep.
Yeah.
Yes.
Okay.
And the voting rights for the sale is between the GPs based on the ownership.
Yeah. So the GPs are basically your conductors. So trusting, loving your GPs and understanding their mission, vision, value is so important. So your GP basically is going to act as a conductor for you in the sale. So if we say, you know what, hey, obviously our money's in there as well. So we're going to be really cognizant of what we do at sale, but we'll say, okay, like, hey, you know what, we have seen that this asset class with more than 10 years left on the lease is going for 5.7 now. And we bought for 6.5. You know, that upside is 800,000, let's just call it. You know, do you want to buy? Or, hey, now the market is accepting a 5.6 on this type of asset class with this type of NOI in this area. Do you want to take it to market? We would all discuss the benefits, the pros, the cons, and then come up with an idea of, okay, if we do end up selling this, what is the minimum we would accept, right? Of an increase in cap rate as well as the performance on the NOI. So it would be, you know, we would do the best interest of what was happening in the market for our investors. We're also in it as well, right? So we would want to make sure that there was a huge upside for all of us.
And just to clarify, the figures that you were throwing out were cap rate figures, not sales figures.
Yes. Yeah. So that's just an example. And I don't know, we can't predict. That's the hard part about the triple nets is we can't predict cap rate all the time, right? I mean, we don't know cap rates last year compared to this year, what they'll be next year. So it would be just watching the market, ensuring that we, you know, are always kind of alert about what's happening with the cap rates. And obviously a big portion is coupling that market rate with an increase in the NOI to get the best return. And that's really what we've done for the past 20 some years. And just to give you an example about our exit, we sold our platform of Montessori preschools to a large, what we could call a triple net childcare provider. It was actually a private equity firm. And we coupled the sale to what we considered was a REIT, was store. They bought all of our real estate locations, but we were able to sell them for a really great price because the market cap rate was way better. And we had a triple net lease in place now for 15 years, where before it was mom and pops, right? Like us. And so between the market cap rate, the NOI that now they were paying, and the exit, we exited at about a 12 cap. 12 times multiple, you know, on our investment. Now, I'm not saying that's typical. I'm just giving you an idea of if you get the right market with the right cap rate and the NOI makes sense, you can have a really lucrative sale of a triple net property, especially with a long lease, because folks don't like to buy short leases, right? On triple nets. We also have, I didn't mention, that's just the primary lease. We have 2 more terms with a 7.5% increase in each additional term of 5 years. So we have 2 more 5-year terms if we wanted to. And with a new build, it's very typical that these buildings for childcare, they'll be in 20, 30, 40 years, right? Once you do all of that FF&E and doing all the leasehold improvements and all the expenses, it's very typical you stay in these spaces for long term because it's really costly to build new childcare centers. So that's just something that I wanted to add in as well.
All right. Any more questions? Okay, great. I mean,
Just two more questions. One, you said all the voting members are basically GPs. There is no LP as a voting member, right?
So just GPs through your GP. So your GP would be responsible to have the vote for whoever they've brought into the deal. Yes.
Oh, okay. And then you said that I guess the deal cap rate was 6.3, I assume.
I don't have it up here right now. Hang on. It was 6. We negotiated it at a 6.5, but I wanted to tell
I
you.
just did 415 divided by the sales price.
Yeah. And so what did you get?
6.3.
Okay. So the sales price is inclusive of the expenses, remember? So prior to that, though, we secured
Okay.
the deal at 6.5. And I said we ended up at that 6.28 to 6.3 after expenses. So yeah, right in line then with that.
Okay. Okay. All
Yeah.
right. And then what is the going cap rate right now with this business in Salt Lake area? Do you know that?
So it really depends because this is a corporate location backed by $1 million guarantee. So you get a little bit, the cap rate is a little lower for a location like that versus say a mom and pop. KinderCare is right in line with that. It's actually right now a little bit even lower. They have 1,300 locations, so they're able to have a little bit more of a pull on the guarantee side as well. So I would say we're anywhere, we're definitely not higher. We're definitely lower in the space of corporate rated AAAs. But I would say in South Lake, one, there's not a ton of corporate care, right? So there's that. And then the ones that are there, like our closest I could compare to would be say like Frisco or McKinney. Those ones we purchased last year at 5.6. And we
Okay.
purchased this at 6.5. So I feel like we're getting a really great deal for the market.
All right. Thank you.
okay. Well, if there's no more questions, you can always feel free to, send us an email, contact us, send me a DM, and then go ahead and soft commit if you do want to reserve your spot, just scanning the QR code on the screen. And we just thank you so much, and we hope that you're as excited as we are about this deal.
Thank you.
Bye.